Welcome everybody to our September investor update. It's been several months since we spoke to you on video. We spoke in April the last time, really at the bottom of the market that we know now, or we believe to know now, and it was also at the peak of the fears of the pandemic. So we've come a long way since, and we've gotten a lot of recovery in the markets, and Bob and I wanted to talk to you a little bit about where we are today and where we're going. At the end of that, I will touch on a little bit of the election and how that affects the markets, because we've got a lot of questions about that, and we'll try to do this briefly. We do have a newsletter that we sent out yesterday that you can get a little bit more detail on this, but I'm going to go ahead and pass this on to Bob. Bob, if you want to go ahead and talk about our asset class performance. Sure. And where we're going.
Thanks, John. Yeah. As you referenced, we've just had a pandemic. We've got social unrest. We've got presidential elections. So it makes sense that markets are at all-time highs, I guess. And we obviously say that a bit kidding around. Obviously, there's something going on, and it's not just a pure organic growth. One of the nice things that we've seen is that while the S&P 500 is at all-time highs, it's really being driven traditionally by the FANG stocks and all that. And what we saw in August is we're getting a much more broader market performance as the smaller caps and the value sectors have also participated. So that's very encouraging. What is concerning to us right now is that when we look at forward PE ratios, and this is our main measure of valuation, we look at the forward operating earnings, we see that really they're at very, very high levels. We've traditionally been less concerned about that than most money managers because of the low rate of inflation. It allows for these higher multiples, but even by our traditional measure of discounting those present values, it's hard to argue that markets are not overvalued a little bit at this point. And then in the bottom right, when we see the operating earnings, it's also encouraging that we're seeing earnings finally moving higher after this pandemic, but earnings really need to catch up to prices. Prices are well ahead of earnings at this point. We all know Q2, record drop in GDP for Q2. We shut down the economy. That happens. I mean, really unprecedented. If we look out at the Q3, obviously we're not done with Q3, but there is the Atlanta Fed does a GDP now forecasting, and we're seeing that they're forecasting for about a 12% bounce in Q3. So that's encouraging. It's probably not sustainable long term, but the bigger message here is that we did not break the economy during the pandemic. So why are markets going up? I think if a picture's worth 1,000 words, this one might be worth 1,000,000. This is the reason. It's a very simple equation. Markets go up when there's more dollars buying than selling. And I guess that's true for any asset. And what we have is we have a Federal Reserve that has gone crazy. At some level, they are just buying up assets. They're directly purchasing assets, even though it's outside of their mandate, through special purpose vehicles. And this is driving the markets higher. We won't get into whether this extreme Keynesian monetary policy makes sense or not, but it's really a pretty simple equation. And our view is that they've probably overstimulated the economy from most monetary standpoint, which they're doing here, but also from the fiscal standpoints of simply sending people money, et cetera. We're just pumping a lot of money into the economy. That money is buying assets. Assets are going up in price. Another reason why stocks continue to do well and have done well is that there's really not any other alternatives out there. If you're an income-oriented investor and you need yield, when you have global yields that are negative, and you have stock dividends at 2%, stocks are yielding more than bonds, which is, again, it's a very strange situation, but it's true. And corporate bond yields are also at record lows as the Fed continues to purchase these in order to keep the servicing cost of the debt down. Great for the companies, not so good for fixed income investors. They really need to take on the risk of stocks if they want any sort of return.
Okay. With that, as we said earlier, there is a more detailed explanation on these charts that we just talked about in the newsletter that we sent out yesterday. But to close up, I wanted to touch on the election. It seems to be, of course, the hot topic of the season right now. People are always calling us and asking how should we invest depending on who wins the election or not. And there's an awful lot of research on this, and I wanted to show you a few charts that would hopefully will calm you a little bit. Really, in the long term, it doesn't matter who is the president, who runs the Senate, who runs the House. In every case, the market tends to go up. It's gone up better in some mixes than others. The only time where we've had a negative market with a mix in Congress is with, on the far right of the bottom chart, is a Republican president, a Democratic Senate, and a Republican House. But that was the 2001 recession and the 9/11 attacks. And there was only 2 times in history where we've had that. So we really need to throw that out. So on average, the market goes up regardless of who is in the White House and who the mix in the Senate and the House is. In an election year, is typically a good year for the markets. Year 1 is good after there's certainty who's in the market or who's in the presidency. Year 2 tends to create a lot of uncertainty because that's when the president and the Congress make a lot of changes. Year 3, again, certainty comes back and the markets tend to do better again on average. A little bit on the corporate tax rates that are proposed by the Biden administration. The corporate tax rate is proposed to go from 21 to 28%, which we view as a negative. Prior to the Trump administration, we were at higher rates, but we had a lot of inversions where US companies were moving overseas. And we were losing that ability to generate revenue by taxing these companies. They would just leave the United States. And by dropping the rates down to 21%, which the Trump administration did, that effectively stopped all the inversions and corporations were staying in the US. So the Biden administration is proposing those rates going up to 28%, which would put us over the global mean, which is around 25%. So we do view that as a modest negative, and we'll see if they actually can get that passed. Hopefully they'll bring that back down to the mean or lower, but they are going to have to raise taxes to some degree given what we've just spent in the economy this year. Personal tax rates are proposed not to change except for people over $400,000 of income, and it's only increasing the top rate from 37 to 39.6. So it's not a dramatic raise like some of the more extreme left candidates would have proposed, so we view this as moderate. The capital gains tax rate is proposed to increase significantly, but only for people with incomes over $1 million. That may affect some investment by the wealthier people in the United States, but the vast majority of people will see no change in the capital gains rates. They are proposing some significant infrastructure spending, which is positive for the economy, and hopefully a more multilateral approach to China rather than the approach that's being taken today. And lastly, the capital gains rate increase proposals. If you go back in history and look at all the capital gains increases and decreases, it really shows no consistency that it has any effect on the market. Even with significant capital gain rate increases, the market tends to go up. We've seen it even with capital gains decreases, the market can go up. So there's no material effect on market performance based on the capital gains rates. And based on the Biden administration, they're not going to change it for anybody under $1 million. So we believe that there should not be any significant impact to the markets because of capital gains. Potentially something short-term at year end after a rate is changed, but that's really all. So that being said, you guys have any questions about any of this, please shoot us an email. Bob and I would be more than happy to get back to you. We're actively working on your portfolios. Fortunately, earlier this week, we did a rebalance on Monday and Tuesday where we reduced equities. The market has certainly reacted pretty negatively in the last few days, but if that continues to happen, I think Bob and I will revisit relative valuations and may add equities again at some point. But again, feel free to call us with any questions you have, and we look forward to talking to all of you.
Thank you.
All right. Stop recording. Do this thing. Stop recording. Okay, so we can cut that.